So how does the average investor then understand this and prepare for this?
Well, in short to intermediate term, they're going to cut rates back to zero, and I had this straight from the horse's mouth, so to speak. I was on last July 23rd. I was at Bretton Woods for the 75th anniversary of the original Bretton Woods International Monetary Conference. We were there on the exact day in 1944, 75 years later. I was in the gold room where the articles were signed.
And for people that don't know what happened that day in 1944.
That was the creation of the Bretton Woods gold standard. So the U.S. called all the shots, designed very much to cause the demise of the British Empire, by the way. And this comes from the credit to Ben Steele. He wrote a book called The Battle of Bretton Woods, which I highly recommend. But the chief U.S. Representative who was the architect of Bretton Woods was a Stalinist agent. He was working for Stalin. He was a communist, Harry Dexter White. But he was Deputy Secretary of the Treasury at the time, and he led the negotiations. His rival was John Maynard Keynes, representing the Exchequer. And Keynes knew that Britain and sterling were not in a position to be the global reserve currency, but he didn't want to be subordinated to the dollar. So he proposed a new reserve currency called the Bancor, which was actually gold-backed. This idea that Keynes hated gold is not true. He had a very nuanced view of gold, and he was in favor of it at the beginning and the end of his career. So he wanted the gold-backed Bancor, and Harry Dexter White said no. The dollar is king. So what they did, they pegged the dollar to gold, and then they pegged all the other currencies to the dollar. Now, indirectly, there was a gold equivalent, but other currencies could devalue against the dollar, and sterling famously did in the 1960s. But the dollar could not devalue against gold. That was the anchor of the whole system until Nixon took it off in 1971.
Okay.
But in the 50s and 60s, you had this Bretton Woods standard. And that was, Bretton Woods, just a little town in northern New Hampshire, and there's a place there, a beautiful resort called the Mount Washington Hotel. And the reason they were there was interesting because John Maynard Keynes said, he was friends with President Roosevelt and had been working all along on this, but he had a really bad heart and he was pretty ill. And he said to the president, he said, for this conference, could we please have it somewhere other than Washington? Because Washington, if you know, is built on a swamp. It's oppressively hot and humid in the summer. And so Keynes said to Roosevelt, can we have this someplace more comfortable? And FDR said, fine. He had a friend who owned the Mount Washington Hotel. Said, I'll send you all up to the White Mountains of New Hampshire. It'll be very comfortable in the summer. And Keynes was grateful. But that's why the conference was held there.
And what happened last year when you were there?
We were back there for this anniversary. We had a great group. Larry Summers was there, former Secretary of the Treasury. Yeah. Ben Steele, the author I mentioned, our friend Julian Tett from the Financial Times. It was a very interesting and high-level group, and a younger crowd, a lot of crypto people. But one of our sessions was closed door, off the record, so I can't mention the names or exact quotes, but one senior official from one of the regional Federal Reserve banks, one member of the Board of Governors, and one governor of the ECB. So this was the real deal. These were among the top central bankers in the world. And I could see this coming, but I was surprised how relaxed they were. So we got to cut rates. So I mean, if investors want to know what's going on, they're going to cut rates probably close to zero, or maybe even zero by this time next year. And they said, yeah. And they had a really nuanced grasp of the difference between real rates and nominal rates, which most people don't have. I go back to the bond market in the early 80s, and I have friends who are still trading bonds. And one by one, they're getting carried out feet first. And we saw this even with bond king Jeff Gundlach, David Isaacson of PIMCO, et cetera. What they say is rates are at an all-time low. They can't go any lower. This is the greatest bond market bubble in history. Short the bonds. Wrong. Nominal rates are low, but real rates are not low. I remember in 1980,
this takes into inflation into account.
Correct.
Right.
In 1980, I got my first mortgage, and I paid 13%. I told my mother, and she cried because her mortgage was like 3% in 1950. I said, Mom, it's a 13% mortgage, but inflation is 15%. So my real rate is -2, and it's tax deductible, and tax rates were 50%. So I got another 6 points of tax benefit. So it was, my real rate was like -7 after taxes. The bank was showering money on me to be a borrower. Mom was still upset, but the point is, that's a negative, 13% nominal rate, but a real rate of -2 before tax. Today, our nominal rates are low, but real rates are not low because inflation is declining. We're in a disinflationary period. And again, I know that, but what the central bankers were saying was, yeah, we got to get real rates negative. And normally you just cut the nominal rate. So here's inflation, cut the nominal rate, get it below inflation, and you have a negative real rate. But they said the problem is the rate of inflation is declining. So we're like a cat chasing its tail. We're racing inflation down, trying to get under it, but it keeps going lower. So
Okay.
we're probably headed for zero. And then they start talking about negative rates.
And so for the average investor, what does that mean? They should look at hard assets like golds? What does
Well,
that mean?
gold definitely, but you should look at Treasury notes. This has been one of the greatest bull markets in Treasury history. And not to get too technical, but for those who understand, what they call duration or convexity, but the easiest way to explain it, when interest rates go down, bond prices go up. It's kind of counterintuitive, but rates down, prices up. So when rates are being cut, you get capital gains on your bonds over and above your coupon. But the amount of the capital gain increases per basis point of rate cuts at lower levels of rates. Again, so no, it's cutting from 2 to 1.5 gives you a bigger capital gain than cutting from 9 to 8.5. It's still a 50 basis point cut, but the bond math is such that the capital gain is even bigger.
Yeah.
Well, if we're going from 10-year note yield to maturity today is around 1.8, give or take. If we're going to 80 basis points or 50 basis points, which I think we are, you're going to have huge capital gains on 10-year Treasury notes.
So you're going to be making a lot of money, and every basis point cut, you're actually going to be making more money as they go lower and
more
lower.
per basis
Kind
point
of basic
cut.
bond math stuff. So
Correct.
This is interesting stuff. So long those Treasury notes.
Long Treasury notes, long gold, other hard assets, real estate. I mean, again, if rates get, real estate, if it's fully leased up or if you're just living in it and you get a rent equivalent, is just like a bond. You cut rates, the value of the rental stream goes up. It's like a bond price goes up. So
Okay.
real estate looks attractive.
Interesting. I haven't heard that comparison before. Okay.